You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Tesla, that stock down by 0.3%. A great scoop by Dana Hall and Ed Ludlow on our Bloomberg News team, talking about how staff at Tesla are bracing for potential job cuts. Apparently, managers were asked to affirm whether each of their employees' position is critical. That feels good.
Yeah.
That always feels really great when you hear that. Joining us now is Steve Mann, Bloomberg Intelligence Global Autos and Industrials Research Analyst. Hey, Steve, what did you make out of the scoop from Bloomberg?
Well, I think, job cuts are never good for the employees, but I think the investors will probably look at it positively because the stock's been down like 12% since their last earnings call and 30% year to date. And that's all because, slowing EV sales, price cuts. So the company needs to do something to address some of the short-term challenges they're facing.
So when I see news like this, it really makes me think, Steve, that maybe they see something fundamental in their business such that they have to look at a big fixed cost like people. What's the company saying these days about where they see, demand?
Well, that's a good question. I think you got two questions there. First of all, fundamentally, they've done a lot of price cutting, in their operations, in the administrative side of things, in their manufacturing. So they're naturally kind of out of, they plucked out all the low-hanging fruits. There's not much to cut anymore other than looking at their human resources. And that's what they're doing at this time. Now, obviously, you don't want to cut, but I think they have to. If you look at Ford's earnings call last night, the market is really brutal. Mm-hmm. The margins was down was at negative 98% for Ford's EV business. That's worse than their third quarter. So from that, you can see the whole entire EV market is still facing, price cuts, slower demand. And that's, I think that's what Tesla is trying to address for 2024.
Hey, Steve, do we have an idea of when the trough might happen for EVs? Is it just going to take cheaper ones, or is it going to be actually more hybrid and that trough be really pushed out?
I think hybrid is a good kind of fill-in between now and when EVs can take off. Our view is actually around 2026, because I think that's when cost of manufacturing EVs will come down. With localization of battery production, more EV models out there, and every automaker right now is talking about the second generation of EV vehicles, the third generation of EV vehicles. They're actually designed on a very different platform than the ICE vehicles, the internal combustion engine vehicles, that is supposed to streamline production, cut the number of parts, and hopefully drive costs down to make it more affordable for the consumers.
So it's a 26 story. Will the charging infrastructure also be a 26 story?
Well, no, there are some spending at the moment to increase charging infrastructure, but that's another bottleneck that the industry is facing. I think out in the West Coast, out in the East Coast, charging infrastructure are not of a big concern, but Central America is. So that's where the focus is, I think, in the next couple of years to really build up the charging infrastructure in that part of the country.
How many charging units do you have at the Princeton campus at Bloomberg right now?
Oh, it's interesting. If you go out to the parking lot here, you think it's a Tesla dealership out here. There's probably 50, 40 to 50 charging stations. Do people have the
cars? Are the Teslas actually being plugged in, or EVs?
Oh yeah. You'll see mostly Tesla. You'll see a couple of Volkswagen, a couple of Volvos, but
because when I was at the Princeton campus, Steve, I guess I haven't been there since before the pandemic. Let's call it 5 years. 5 years ago we had 2. Now you're telling me we have 50. That is a good barometer, I think. Now I think Bloomberg is usually on the cutting edge of this stuff, but still interesting.
Yeah, and I wonder, did you get the idea that the charging was there, therefore you brought the EVs, or it's just a clientele that has the EVs? Unfair question, but like, what do you think?
That's a good question. It's all about the cost of ownership. I think you're right, Alex. Having the charging stations here, make it convenient for people to charge and really cut their, monthly costs, right? There's no fuel costs anymore with the EVs. But it's all about the cost of ownership.
It's free. The energy's free.
We should be charging you people down there. I'm not going for this.
Nah, they got the solar panels out back. They got
free
the EV
lunch.
They got
Literally
the
free lunch.
It's awesome down there. All right, Steve, thanks so much for joining us.
Great.
Steve Mann, he's a global autos industrials research. He's down there in Bloomberg in our Princeton office, which is really cool. That was one of the Bloomberg's first offices down there. They had the global data folks, and I don't know how many people we have down there, 3,000, maybe more. Do some awesome work down there, and that's where a lot of the BI folks
And
are
also
there.
all the EVs, apparently.
Apparently all the EVs 50. That's pretty cool.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's go to Herman Chan here. He's the senior analyst covering the regional banks. Herman, New York Community Bank, that's the story of, I guess, the last several days. What's the current status of that? Is that something that bank investors in general have to worry about, regional banks in this country?
Sure. I think it's definitely brought to the forefront worries about commercial real estate in particular, but really New York Community's issues are a bit idiosyncratic because they just crossed over that $100 billion threshold that requires tougher regulatory scrutiny. And New York Community is also the dominant lender in the rent-regulated apartment lending area here in New York, so not much read across to other regionals.
Well, we also had a headline that they want to sell some of their RV loans and offload some mortgage risk. Are they going to be the buyers for that?
Right. So that's going to be an issue for them.
Or I guess the buyers at the right price.
Buyers at the right price. So for New York Community, what these two actions are really a bid to improve their capital ratios. They've talked about lifting their CET1 ratio to 10% by the end of the year, which would be more in line with their larger regional banking peers. And so the synthetic transaction to add insurance on their residential mortgage loans and offload some RV loans is designed to potentially do that.
RV loans. Now, these are recreational vehicle loans. John Tucker thought there was some technical, arcane term. These are for recreational.
To be fair to John Tucker, that was me.
Okay.
I was the one who was like, is this a specialized sort of loan?
So is that a thing?
Yeah, so it's a thing that some regional banks actually do, and it's a lucrative business. You can think of that sort of like an auto loan, but just for RVs. And banks like M&T and Bank OZK.
Bank of the Ozarks.
Yeah, Bank of the
Big
Ozarks.
RV country down there.
These are RV
Nice.
lenders. Yeah.
Nice.
Well, also remember that RVs were super hot in 2020. Everyone wanted them. You couldn't make them fast enough because that was the only vacation you could have.
That's
Get in your
right.
RV, go around. So
That's right.
what's going to be
Explore the open road.
Exactly. What's going to be next for this company? Because you could make an argument that they're doing everything right, and I'm putting that in quotes, in terms of updating investors, getting their books in order,
right,
etc. So what do they do now?
They're trying to control the narrative, but the market's saying something else entirely, where the market's concerned that even though liquidity is in a pretty good shape and deposits are actually up but since the end of the year, are they going to be able to generate enough earnings to meet their capital ratios, and how are they going to fare in the upcoming stress test? When they did that, if you step back and when you look at what they did after they announced the signature transaction last year, when they were viewed as a savior, they could have been, I guess, maybe a bit more aggressive in building up their capital and liquidity back then, so they're not in a pickle now, but that's really spilled milk at this point.
So one of the themes that I'm still in the back of my mind, if I were bank investors, I just don't know the magnitude of some of these commercial real estate exposures. I believe in the past you've said for most lenders it's not that big a deal. Is that right?
Well, we're going to talk specifically about office commercial real estate, where that's
right.
really the potential boogeyman here. on average, across our research coverage, which covers the largest 19, 20 regional banks, it's 2% of their total loan book. So it's actually really small and manageable. And and then on top of that, you have pretty conservative underwriting, and they know this is a risk, and the regulators know this is a risk. So the banks have already started to build up reserves to protect against potential losses. So put that all together, it just seems like it's going to be a manageable issue. But you're going to see losses eventually.
So can this bank stay in business?
That's going to be an open question. They've tried to put a very encouraging view out there on their earnings, on their management call earlier this morning, talking about the strength of the deposit franchise, and you're not seeing deposits flow out of the branches, and they have a boost to liquidity. So they're what they need is time, and it remains to be seen if the market's going to give them time to build up their capital.
Right.
I want some M&A. I want some business. I want to come in here every Monday morning and see company A, bank A buying bank B.
But that's what they did, and look what they're in now.
That's true. Right. So, be careful. Be careful.
I don't know about
what
that.
you wish
Be
for.
careful what you wish for. Are we going to see some of that, do you think?
This whole issue surrounding your community, where they came in, helped out the FDIC and the regulators, and really helped out the banking system by taking over Signature. And now they're in this pickle where they have to adhere to these tougher regulations, clearing that 100 billion mark. I don't think any other bank that's going to be in this same situation wants to jump into that same scenario.
Can I ask a quick stupid question? Is there a stock price that we need to be worried about? Is it 370? Well, zero, but 379 right now, down another 10% today?
Right. I think if the market pressure continues, it's going to be something where the regulators take a more focused view and maybe be more forceful with what's next.
But you have to wonder, too, they were able to do that with SVB and First Republic, right? Mm-hmm. But now look at what happened with this bank, which bought some of First Republic assets because of that. So what will regulators do
JP Morgan
in relation to that? Right. Hey, Jamie.
Jamie.
Sorry to ask, but I got another favor you got to do me for here.
Yeah, sorry to bother you down in St. Bart's, but can you go over and buy your New York Community Bank? Herman Chan, thank you so much. We appreciate that. Herman Chan, he's a senior analyst. He covers the regional banks in the U.S. for us. Has been a go-to source here really over the last 12 to 18 months as we kind of figure out what's happening with the regional bank business.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, let's get a sense of what we're doing here with this market. So we're about halfway through the earnings for the quarter. We've got a Fed that presumably is in the mood of rate cutting. So what do we do here? Carol Schleif joins us. She's a chief investment officer at BMO Family Offices. I remember when they were Bank of Montreal, but consultant came in and said BMO and shortened it to BMO. Yep. So, but Bank of Montreal bought a lot of my loans that I originated at Chase. So we love those folks. Carol, what are we doing with this market here? I had a great November and December. I'm not sure if everybody else did, but I had a great period there. I'm wondering what do I do now in 2024?
Yeah, November and December were definitely fun periods, especially coming up after October. But we think the market's got a little over their skis with exuberance about how soon and how often the Fed was going to cut this year. And so some rationalization of that coming into this year's actually makes a lot of sense. But our approach really hasn't changed much. We actually were in the soft landing camp all of last year from the beginning of the year on, thinking the Fed was going to be able to navigate both keeping the employment and the economy humming along while we were seeing inflation straighten itself out. Mm-hmm. But coming into this year, keeping that balanced approach to risk where you're getting paid to invest in some bonds, so having that portion of your portfolio maybe out of cash into some of those higher yielding short and intermediate term bonds, but then also not wanting to back away from a growth oriented sort of, we think the economy's in decent shape. We think you'll see a broadening like you saw in November and December last year. The most encouraging thing about that period was seeing that broadening of the market, the participation. You narrowed it up on the good days here as we've had earnings from the Magnificent 7 or 5 or 2, as you were talking earlier. But bringing that through and continuing to see more participation in mid and small cap will really be necessary. And we think
so, Carol, But I guess I wonder when we get there, because it doesn't seem like no one's going to sell right now. Like, that feels clear, right? The hurdle to sell feels really high. But if I have money in a money market fund, the hurdle to then buy here feels also really high. So what am I supposed to do?
Yeah, it does. It feels high until we're looking back and the Fed's done a couple cuts, and all of a sudden your 5% in cash is 3.5%.
So I need to buy small caps now?
Is smaller mid cap in terms of more broadly, and there's ways to do it in a passive way. There's ways to look through, are there interesting sectors or industries or actively managed ETFs that you want to be part of? There's some secular stories going on out there as it relates to artificial intelligence, as it relates to infrastructure rebuild. There's some active ETFs that follow those segments, if you will. And so there's interesting ways to play it. And then again, too, even if you have passive S&P exposure and dollar cost average into that, you're getting participation de facto by the overweight in those major indexes to technology in the United States here in particular.
So, Carol, when you talk to your clients at BMO Family Office, the financial consultants at BMO, what's the ETF allocation for you guys? How often do you recommend an ETF to get at, maybe just exposure to fixed income or just different asset classes? So how important are ETFs?
Well, ETFs play a role, so do active and passive. We also have passively managed passively managed tax efficient strategies where we can do separate accounts. So there's a variety. It depends on the size of the account. It depends on the inclinations. If we're going to take and say adopt an exposure to an extra exposure to Japan or artificial intelligence, we might take a 3 to 5% position in a particular ETF or a suite of ETFs. If the account is such a size that we want to use ETFs to deploy some short, intermediate, long-term bonds, the whole position might be in a variety of ETFs, and they would most likely be passive there.
What do you really hate right now? Like, what can you not touch?
What could we not touch?
Yeah.
I'm not sure, depending on the client, that there's anything we really hate, if you will. That's part of being balanced. We're going to be underweight some certain things, emerging markets, developed markets in Europe. We're underweight those relative to the overweight we've had in the United States. Sector-wise, it's tough because there's a lot of interesting things going on, especially from a secular build standpoint in the United States. And there's a lot of things that are overlooked and unloved. We don't hate technology, but clearly that's where all the emphasis has been. But there's a lot of things like industrial and infrastructure companies where when you look at those as sectors, they're only 10 or 12% of the S&P. And we think you'll see that grow as we reindustrialize and bring manufacturing back here as we build out the grid. You mentioned having the green and the hook you need to get it on the grid. Also in places where, take Minnesota, where you've got the western part of the state is where the solar can be built, but it's not attached to the grid. So they actually have to build hundreds of miles of transmission power just to get it to the grid.
To be fair, there is like a name for that thing.
That thingy?
But I just know it is the thing that you need to plug into the grid.
Right.
But there is an
That's
official
all we
name.
need to know.
The pluggy thing.
It's the pluggy thing. We'll just coin that right here.
So, Carol, we're about halfway through earnings here. Is anything kind of jumping out at you here? Are you okay with the earnings? Do you think we're seeing some cracks maybe in the earnings power out there?
I think the thing that jumps out at me on earnings is that you can't broad brush stroke even an entire sector. There's been a lot of dispersion in those sectors about the haves and the have-nots. There's also been a lot of dispersion in how investors are treating them, because a company might beat on the top and the bottom line and they nail the stock because they don't like what the CFO said in the conference call. And so it's really, it feels and smells like we're back into a stock pickers market, where actively managed should have an advantage if they've got deep and broad research. And so that's one of the things that strikes me, because overall earnings are pretty reasonable. They're not as exuberant on the beats on the top and bottom line as they have been in prior quarters, but they're reasonable and they're consistent with this economy. The other thing that's really notable is companies are seeing from the reaction in other stock prices that if they announce, oh, we're trimming heads over here and we're cutting costs over here, the stock prices go up, sort of no matter what the numbers are, because it looks like management teams are staying really focused to be laser precise in how they're running their business. And the street likes that.
It does, absolutely. We saw that with Meta last year. Just amazing. Carol Schleif, Chief Investment Officer for BMO Family Office. Thanks so much for joining us. Based out there in Minneapolis, St. Paul. I happen to be a St. Paul fan versus Minneapolis. That's just I thought the architecture in St. Paul is really cool.
I've never been to St. Paul.
Is that awesome. The airport that has a plane hanging from the ceiling?
I think so.
Okay.
I don't know. It's just I've been to so many airports in the Midwest. I
can't help you out with this one.
Yeah,
I got
great hotel. I forget the name of the hotel that I like staying at in St. Paul. It's just awesome. Really old school.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Disney reporting after the closing bell today. Of course, yesterday we got the news that ESPN, Fox, and Warner Brothers were going to do a streaming sports service. I don't truly understand what that means, but luckily Geetha Ranganathan is here with us, Bloomberg Intelligence Analyst on U.S. media. Geetha, is everyone going to ignore the quarter now and just focus on this ESPN thing?
Yeah, definitely big news, Alix. Absolutely. I think there are a lot of, obviously it raised more questions than answers, but potentially could be a huge game changer. I mean, especially if it kind of comes out at a really, really attractive price point.
So, Geetha, why are they doing it now, do you think? I mean, what's kind of the strategy there? Are they trying to get people who just don't watch sports, who don't have subscribed to cable? What's the play here?
Yeah, I think, definitely we know that we've lost about 30 million consumers to cord cutting. It used to be 100 million. We're now down to 70 million. We also have multiple folks who have actually never subscribed to a pay TV bundle. And a lot of them actually tend to be very hardcore sports enthusiasts. So the companies are actually pinning that market at about 60 million potential subscribers. So there's obviously a huge target market for them. And I think this is really a way, Paul, for these companies to kind of finally take control of their own destinies in a way, right? They own content production, but they have never, owned distribution. They've always kind of been at the mercy of the pay TV distributor. And so this is a way for them kind of, I think, whatever you want to call it, but in a way kind of future-proofing their revenue streams.
So when you say an attractive price, what is that price?
So there have been some rumors out there. So we know an attractive price has to be something way below the $70 pay TV package, right? That's what we're paying right now if you just want to buy this package off of Comcast or Charter or any of the pay TV operators out there. It's obviously not going to be as low as, say, a regular streaming service, right? Like Netflix for $20. It's obviously going to have to be higher than that. We have seen some reports trickle in about a potential $40 to $50 price point. I would say that is still pretty attractive for a hardcore sports fan. Of course, some others will argue that you're still not going to get all of the sports, right? You're not having Paramount, you're not having, NBC content. So it's still going to be somewhat of an incomplete package. So it remains to be seen, the devil obviously is in the details. We'll have to wait and watch and see if, they're going to be able to license out any of the other sports or how it exactly works. But I would say at first glance, the $40 price point seems pretty attractive.
Well, I got to pay for that somehow. And I think the way I'm going to pay for it, Geetha, is I'm going to call up Comcast and cancel my video package and just keep broadband. The cable companies can't be very happy about this.
No way. I mean, this is really, I think, and if you just kind of look at the market reaction today, you look at the broadcasters, you look at some of these other media companies, obviously very negative reaction. And I think a lot of that is kind of exactly this point that you're bringing up, Paul, which is this worry that this is actually going to accelerate cord cutting. So we already know that cord cutting is running at about, it used to be back in the day, it used to be 2%, 3%, just the kind of this little trickle. So nobody was really overly concerned about it. Of course, now that has accelerated to about 8.5% right now. And I think this news obviously can take it well into the double digits. And that's really a dismally bleak future for all of these broadcasters.
Do you think that the broadcasters are surprised by this? I mean, they had to have seen something like this coming, right? Like, what's their plan A, B, C, D?
Yeah, I mean, I think we kind of knew that ESPN was going to do it, but just kind of getting this more robust bundle, having, both like if you kind of think about it, Fox has never ever said, in fact, they've been always kind of married to the pay TV bundle. So having them kind of do something like this obviously is a little bit of a shock, I would say, in some ways. Similarly, Warner Brothers Discovery, again, they don't have too much of sports, but they do have some sports that really count, which is the NBA and March Madness. And so, again, having them kind of participate and make this kind of this bigger streaming service, I think definitely came as a little bit of a surprise, if not as kind of blindsiding some of these broadcasters.
All right, so I'm guessing on the conference call this afternoon after the market closed when Disney reports earnings, this will be a topic of conversation. But there's a long list of issues for Disney and investors. What's topic number one for you, aside from what's going on here with the sports business?
I think the two things that everybody is kind of really looking to is, what the streaming profitability numbers are going to look like. I mean, Disney has obviously already done a really, really good job, Paul, in terms of bearing those streaming losses. So just 2 years ago, they were losing about $4 billion a year. Last year, they kind of really cut that down to about $2.5 billion. This year, hopefully, they get it down even lower. They're supposed to turn break even to slightly positive by the end of the fourth quarter, but any kind of guidance that they can offer on that front, I think, is something that investors are going to be looking very, very closely at. And then I think in general, just the cost-cutting efforts, right? We've seen Disney already do a fantastic job. I think in many ways, even the sports streaming service kind of speaks to that whole concept of, rationalization of sports costs, because when they kind of bid in the future for sports rights, the joint venture kind of really helps them limit the downside, I think, in many ways, because sports makes up 40% of Disney's total content bill. So it's a huge part for them. So I think anything on those two fronts, cost cutting and streaming profitability, will be top of mind.
So let's go to the streaming profitability for a second. What is less bad versus good?
So right now, less bad is good, because nobody's making profits right now, other than, of course, Netflix, which just threw out about $7 billion of EBITDA, $7 billion of cash flow. None of these other big media companies are doing it. And so that is kind of, the guiding light, if you will. I mean, everybody wants to be Netflix. Of course, it's not easy to get there. There's going to be a lot of challenges down the road. But I think that, we do have one streamer that has kind of achieved profitability. We do have Netflix at 20% operating margins. It's going to take a long time for Disney, for a lot of these other peers to kind of get anywhere close to Netflix, but I think they know what they have to achieve if they've got to win over the street.
Does Bob Iger have a successor yet? Because that's still kind of an issue.
No, I mean, maybe they do. I'm not really sure. I mean, the one thing that I think was kind of a little bit surprising is their hiring of an external CFO. So we've always kind of seen Disney go internal for a lot of these key management hires. It was interesting that they kind of have Mr. Johnston there in the CFO post. I think obviously he's going to do extremely well, but I think that again raises the question of whether they will kind of look externally for a candidate to lead Disney.
Is Disney stock a value trap at this point? She keeps laughing at us. I don't know what that means.
I wish I knew the answers. I mean, if you just kind of look at the profit profile of this company, it's actually really, really strong. I mean, when I think about the EPS potential, I mean, it's 10 to 15% EPS growth over the next few years, especially if it gets to streaming profitability pretty quickly. So in that situation, I think, the stock will definitely have to re-rate. So, I mean, it all kind of now boils down to what they're going to say on the profitability numbers, what they're going to say on this new streaming service, whether that is going to accelerate the whole profit profile. So, the devil, again, is going to be in those details.
All right, Geetha, you're going to be busy this afternoon. I think a lot of people are going to be listening into this call to figure out how they're going to get their sports going forward. Who cares about the EPS, but what do I have to buy? What do I have to pay to get all my sports here? So we'll be paying attention to that. Geetha Ranganathan, she covers all of the media stuff for Bloomberg Intelligence based down in Princeton, New Jersey. So all I know is I'm not going to pay an incremental $40 for stuff I already get. So, I mean, I'm just going to cut.
But have you cut the cord?
No.
Okay.
I haven't.
And you haven't because?
Well, mostly sports. Sports. So now if I can get, but CBS isn't part of this package. Mm-hmm. So that's a problem because they have a lot of football that you like to watch. They have a lot of NCAA basketball they like to watch. So it's really getting difficult here, I think, for the consumer before, I mean, what I used to argue for people is, yeah, you're upset about the cable bill. Everybody's upset about their cable bill. But man, it's convenient. It's one check, and you get everything. Now you're writing 6, 7, 8 checks, and are you getting a better product?
Right.
I don't know.
First of all, he's still writing checks. Let's just
No,
log
that was just
and
a
put that aside.
figure of thought.
Yeah, but then I
There's a
also wonder,
generational thing going on
you
here.
but you were bringing up the idea that
I
like
walk up and pay cash to the
he does.
Comcast
He just
counter.
gives it right to them. That we're going to have like a bundle for streaming too. That eventually they'll have to bundle up to sort of sidestep exactly what you're just talking about.
Yep. It is the total disruption of the media marketplace, and who pays? I think the consumer does here. So certainly in terms of convenience.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's get the perspective, though, on how to invest and where to put money when we're near 5,000, which really, let's be honest, means nothing with the S&P. People like round numbers, but I don't feel a lot of conviction heading into this. Phil Orlando is Chief Equity Strategist with Federated Hermes, and he joins us now. Phil, do you buy this rally here? Do you sell it? Do you sit tight? What do you do?
First of all, Alex, thank you very much for having me back on the program. Your previous guest made an interesting comment about buying dips, and that dip at 4,100 in late October was a great buying opportunity. We, like I'm sure a lot of folks, were all in at that time, but the market has now rallied by 22% from the end of October up here to a week into February. The Magnificent Seven has really driven that rally. Last year, the Mag 7 was up 76%. The S&P was up 24%. The other 493 names were up 12%. So there's a valuation disparity that's been created here, and that's the point I'd like to make. We think that a lot of the froth in the market should spread out, and this rally should diversify, should broaden out. The areas of the market that were left for dead last year, domestic large cap value, domestic small cap growth, international. Those are the areas that we think have some room to run here. And we'd be very nervous with stocks up here, as you said, knocking on the door at 5,000. We're only 4% away from our full year target of 5,200. So something's got to give here.
That's right.
All right, are earnings going to give here? I mean, can we see an earnings growth driven market here? What are you seeing?
I think that's a great point, Paul, that as we look at the cumulative effect of what the Federal Reserve has done in terms of tightening monetary policy over the last, 2 years, right? They took interest rates from 0 to 5.5%. They've shrunk the balance sheet from $9 trillion down to $7.7 trillion. We think that the cumulative weight of that tightening is going to start to have an impact on the economy and corporate earnings. So we saw that the fourth quarter was slower than the third. We think that over the course of this year, the first 3 quarters of this year, GDP growth is going to be in that, 1.5% neighborhood. Not a recession. We're in the soft landing camp. But if GDP drops down from, let's say, 5% in last year's third quarter to 1% at its trough this year, should there be a commensurate decline in corporate earnings? Earnings growth is going to slow. And we think ultimately, given where valuation levels are, we could see some slowing in some stocks, particularly the growth and technology names that have just had a phenomenal run here over the last year or so.
Small cap trade, though, worked for a second last year, and then it didn't. What gives you the confidence that this time will be different?
The four most dangerous words in the English language for an investor. This time it's different. What we're focused on within the small cap growth space domestically is healthcare, with a real focus on biotechnology. As we talk to our biotech experts here, the drug pipeline for these companies has never been stronger. The valuations have never been cheaper. And if interest rates are in fact going to go down over the course of this year, which we believe they will, that should make the potential for M&A, merger and acquisition activity, more prominent. So given the valuation imbalance, we think small caps, again, specifically biotech, ought to work.
All right, Phil, how about just some sectors in general here? I mean, you mentioned the tech names, which have been a leader. A lot of folks feel like they need to continue to be a leader to move this market higher. Is there other places I need to be looking? Because unlike John Tucker, I did not own the Mag 7 last year.
Well, more broadly speaking, let's look over in the domestic large cap value area that I mentioned. There are two categories there, financials and energy, that we like a lot. Energy, crude prices are working higher. We've gone from the mid-60s to the mid-70s over the last couple of months based upon all of this instability, in the Middle East. The stocks really haven't participated. We could see crude prices, in our view, working back to $80, $90 a barrel, given all of this volatility on the underlying commodities. So energy should work. P's are low, dividend yields are very high. And then financial services. You go back a year ago when Silicon Valley Bank and that whole thing blew up, these stocks dropped 50%. Now, what we know now, or we think we know now, is that the problems were largely concentrated in a handful of companies that were poorly managed. And the rest of the banking industry, particularly the large cap names, are relatively in good shape, but they haven't come back to where they were or should have been. We think there's some catch up that will play out over the course of this year for them as well.
So, but we see New York Community Bank, and you could say that they bought some stuff from First Republic, and that's kind of why they're in that mess. So do you think...
That was going to be my answer.
Okay. So, but what about some of the regionals that aren't that company and that aren't like the JP Morgans? Like, do we need to be looking at those between like 200 and 250 billion, or is that going to be too risky?
Well, and I think we get into a stock picker's market environment where you've got to do your fundamental due diligence on these companies. And what do their balance sheet and income statements look like? Do they have the same sort of exposure to commercial real estate that Silicon Valley Bank or New York Community Bank did? Do they have the mismatch in assets and liabilities? Or have we just thrown out the baby with the bathwater? So that's got to be an individual decision that the analyst and the portfolio manager is going to make about whether an individual regional bank or money center has the same problems that some of the ones that have got taken out behind the woodshed, and rightly so, a year ago.
All right, very good. Phil Orlando, thank you so much for joining us. Phil Orlando, he's a chief equity market strategist, and he's head of the client portfolio group at Federated Hermes, joining us via Zoom from New York City.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.